Buckle up, investors! We're diving straight into the thrilling world of stock market, focusing on Lloyds Banking Group's recent £1.8 billion share buyback. Now, if you're wondering what a share buyback is, it's essentially when a company reacquires its own shares from the marketplace. It's a way for a company to reinvest in itself, reducing the number of outstanding shares on the market, which can increase the proportion of shares a company owns. So, why did Lloyds decide to take this route? Well, it's a strategic move, folks. Lloyds, like many other companies, uses share buybacks as a way to return capital to shareholders. It's kind of like when you're playing poker and you decide to bet on yourself because you believe in the hand you're holding. In the same vein, Lloyds is betting on itself. Now, here's where it gets interesting. This move could potentially send the Lloyds share price higher. It's a bit of a supply and demand situation. When a company buys back its shares, the number of shares in circulation decreases. With fewer shares available, the price can go up if the demand remains the same. Of course, this isn't a surefire thing. Share prices are influenced by a multitude of factors, but it's definitely something to keep an eye on. According to some reports, this is the largest buyback program Lloyds has embarked upon since 2019, which suggests a certain level of confidence in their financial position and future prospects. So, what's the takeaway here? Well, it's clear that Lloyds is playing a strategic game here. They're indicating a strong belief in their own value and are willing to put their money where their mouth is. But what does it mean for you as an investor? So you've got some Lloyds shares in your portfolio, or maybe you're thinking about it. Let's get into what this buyback could mean for you. When a company like Lloyds Banking Group decides to buy back its shares, it's essentially investing in itself. This can have some interesting implications for shareholders and potential investors. Let's delve into this. One of the main implications of a share buyback is the potential increase in earnings per share. Here's how it works. By buying back its shares, a company reduces the number of shares in circulation. With fewer shares out there, each remaining share represents a larger slice of the company's earnings. This can make the stock more attractive to investors, as it implies higher earnings per share. Now, this doesn't necessarily mean that the company is actually making more money overall, but it does mean that the earnings are spread out over fewer shares, which can make each share more valuable. It's a bit like having a pie and cutting it into fewer pieces. Each piece might not be bigger, but it represents a larger portion of the whole pie. But what does this mean for you as an existing shareholder or potential investor? Well, if you already own shares in Lloyds, this could potentially increase the value of your shares. And if you're considering investing, this could make Lloyds a more attractive option. Of course, it's important to remember that share buybacks are just one factor to consider when investing. They can indicate a company's confidence in its future prospects, but they're not a guarantee of future performance. It's always important to do your homework and consider a range of factors before making an investment decision. So, while this share buyback could be good news for Lloyds shareholders, it's also important to consider the broader picture. What are the company's growth prospects? What's happening in the wider market? These are all important questions to consider. It seems like Lloyds shareholders could be in for a treat. But what's the larger market saying about this? The market is a fickle beast, ever reacting, ever predicting. Let's see how it's responding to Lloyds' big move. As the news of Lloyds Banking Group's hefty £1.8 billion share buyback broke, the market was quick to respond. Investors and analysts alike scrambled to dissect the implications of this bold move. There was a palpable sense of anticipation. Would this be the catalyst to propel Lloyd's share price to new heights? The initial reaction was positive. The announcement sparked interest and ignited discussions. Market experts, those seasoned navigators of the volatile seas of finance, weighed in with their analysis. The consensus? A cautious optimism. The buyback was seen as a vote of confidence in Lloyd's future prospects, a sign of robust financial health. But where there's reward, there's risk. And the experts were quick to point out potential downsides. Share buybacks, while beneficial in the short term, can sometimes be a double-edged sword. They can lead to an inflated share price, creating a bubble that could potentially burst. Additionally, the money spent on the buyback is money that's not being invested elsewhere. In innovation, in expansion, in future-proofing the business. So what's the prediction for Lloyd's future? Well, as with any market forecast, it's a mix of educated guesses and crystal ball gazing. Some predict a steady rise in share price buoyed by the buyback. Others warn of potential pitfalls ahead, but all agree on one thing. It's a bold move by Lloyds, one that's sure to keep them in the spotlight in the coming months. Only time will tell if Lloyds' gamble pays off, but one thing's for sure, it's going to be an interesting ride. And before we wrap up, a quick reminder to hit that subscribe button for more insights into the exciting world of investing. Stay tuned, stay informed.